Well, this is your Wall Street wake-up call. Global stocks falling as investors flock to safe haven fixed income assets. Let's bring in Michael Ingram now, a market analyst with BGC Partners in London. So, Michael, government bond yields in Japan, Germany, and the UK reaching new record lows. What's driving this?
Well, Scott, I think it's actually a growth shock as much as anything else. Some people have described it this morning as risk-off. I think if it truly were risk-off, you'd actually see credit behaving less well. You'd see periphery spreads in Europe blow out, particularly in Spain, where, of course, we're looking at elections, which could bring in a new government on the 26th of June. We're not really seeing that, but certainly markets, I think, factoring in lower growth. Of course, we had those lower forecasts from the World Bank at the start of this week, trimming growth rates pretty much everywhere. And of course, you know, we are a week away now from those dire non-farm payrolls out of the US. You know, we all questioned why the market wasn't reacting more to those horrific numbers last Friday. Well, maybe this is like a Wile E. Coyote moment. Maybe the market suddenly realized it should have been reacting to them, and it's playing catch up for whatever reason. You know, market's looking pretty ugly today.
Well, and you say markets are on borrowed time after those jobs numbers last Friday, because all we have seen since then is stocks sort of creep higher, nearing those record highs, especially in the S&P 500.
Yeah, I mean, I think for me, what I've really been looking for the last year or so is more fundamental support from earnings, and you haven't really seen that. So far this year, you've actually seen some stabilization on the S&P 500 earnings outlooks, though they are still down year to date, but you haven't seen that kind of stabilization in continental Europe. You haven't really seen it in the UK, and you certainly haven't seen it in Japan. So where does that leave you? Well, if you want higher market levels, you're asking to pay higher and higher multiples, despite the fact that the growth outlook of anything is continuing to deteriorate. So, you know, at some point, people say, well, do you know what? It's just a tulip bulb. Maybe I shouldn't be paying this price for that tulip bulb. And they all pile out the door, and maybe we're getting a whiff of that today.
Well, also, I mean, we're seeing these bond yields sort of creep very close to negative territory, especially in Germany and in Japan. They are in negative territory. What does that tell you?
Well, if you believe the bond market, it tells you the growth outlook is very, very poor indeed. Yes, of course, central banks are active along that part of the yield curve, helping to push rates low. So perhaps, you know, one might not totally take on board what the market, inverted commas, is actually telling us there. But, you know, you'd have to say it doesn't exactly paint a picture of healthy growth. After all, you know, there is supposed to be some sort of linkage between nominal GDP growth and long bond yields. And if that holds true, then the outlook for growth, the growth inflation combination is very poor indeed.
All right, just very quickly, I'm going to ask you to simplify this for us. Do we stay away from stocks right now?
Yeah, I mean, I felt for some time that this rally has been built on sand. I think all we've seen over the last couple of months effectively has been a bear market rally, and I certainly wouldn't be touching anything, certainly not this side of a UK referendum.
All right, Michael Ingram, thanks so much for joining us. Great stuff.
My pleasure.
I'm Scott Gamm, and you're watching The Street.